Thank you so much for coming to check out another episode of the Stash Cast, where we have interesting conversations with interesting people focused on commercial real estate and the world of prop tech. The Stash Cast is brought to you by Needle. What if you could use data and analytics to predict transactions before they occur? You can with Needle. Come check it out at needle, NEDL.us to learn more. All right. Today we have my friend Josh Goodwin here with us. Super excited for it. We've been talking about it for a little while and glad to have you.
Thanks for having me. I'm excited.
Yeah. So Josh, why don't we start out? Why don't you give the people a feel for who you are and what you do?
Sure. I mean, I'm from the UK. You'll quickly realize that with my accent, but I spent formative years here in the United States. And so my accent will flow in and out of English and American throughout the course of the conversation. I promise you it's not being put on. It just is the way that I talk now, apparently. I'm a professional real estate investor and I work for, I'm a co-founder of SimCap Holdings, which is a holding company, and we purchase residential multifamily assets, initially just my partner and I. And now it has since grown to include syndications and now a fund. So it continues to evolve, which is quite exciting.
That's great, man. How did you get started in commercial real estate?
So commercial real estate, I got started as I jumped from the residential world.
Okay.
I used to own a company called Arc Listings, which was exciting, but also super boring because residential real estate to me is dull. It's a lot of hand holding. It's a lot of sort of shepherding a buying group that might be less sophisticated than your clients in the commercial space. And I feel like you have to be disingenuous quite a bit in residential real estate. You have to pretend that you enjoy or like certain aspects because you are trying to get a sale. And I didn't really, it ate me up inside. I sold the company and moved on to commercial real estate, but I've always been very interested in it as a category. That's how I made the jump. That's the easiest way to summarize it.
Yeah, there is definitely emotion involved in commercial real estate, but that tends to be less about the property and more about the people involved in the transaction, I think.
Oh, certainly, for sure. It's emotional, commercial real estate, but it's more financial emotion, which is a bit different.
Yeah. Yeah. It's different because in residential, you're talking about this is where I'm going to live and spend my life and raise my kids or whatever it is. Whereas these are the numbers and this is how the deal works. And sorry.
It's more binary,
Yeah. Um,
certainly.
so how did you grow up in the United Kingdom and then find your way here to beautiful Cincinnati, Ohio?
Common question, but it is beautiful today, for the
Yeah.
record. My father worked for Procter and Gamble, and it's an old tale, right? All roads lead to Cincinnati through that means. So I ended up moving around a lot as a kid. I moved from England to Belgium to Poland and other countries before arriving in the United States when I was 13. And that's when I went to school here in Cincinnati. And then it was only after high school that I went back to the United Kingdom, went to university in Scotland at the University of St Andrews, and then came back to Cincinnati because I really wanted to be in banking. And I wanted to be in America, mainly because my green card was towards the end of its expiration timeline. And I really wanted a green card because it's one of the most powerful pieces of paper that you can own. Long story short, there were other, at the time, I thought sexier cities that I could live in, maybe New York or Chicago. But then they found out that I used to live in Cincinnati, and being in like private wealth management, it's all about relationships. So they said, go back to Cincinnati. And it's actually a blessing in disguise, though, because I was resistant to it initially, but came back here. And now I find it to be one of the most interesting and like up and coming cities in America. And the numbers tell the same story. So that's how I ended up back here. And I've since moved my wife over from Scotland, and we have set up camp here, and we intend to stay.
That's great. So why do you love Cincinnati? What about this market is so intriguing to you?
I'll probably sound like a broken record, but it has this big town feel in the sense that it offers a bunch of professional sports teams, really live and active arts programs. But I can see one side of Cincinnati from the other, depending on where you stand. I really like the fact that it blends the two characteristics of things that I love, which is like a city feel, but it's more personal. I've lived briefly in London, and I've just got back to New York last week, and they just are completely different environments. Very good for a night out. Very good if you have nothing to do and you're like, what can we do tonight? Whereas Cincinnati, you got to plan ahead because it's what is coming up to do. And if
Yeah.
nothing's occurring, then nothing's occurring. But there's a litany of reasons why I like Cincinnati, excluding the Bengals, which I don't
That's like blasphemy. I like to say that Cincinnati has a big town, small city feel to it. That's what, 2 degrees of separation, 2 or 3 degrees of separation here in town.
Yeah,
Everybody knows everybody, so you better behave yourself.
right.
Um,
Everyone knows everybody, but like to a certain extent, you still can get away with stuff. And it's not like it's a town, a true town,
right.
where
Yeah.
you bump into the sheriff at a bar or something. No, that's not the case.
No. Yeah, no, it is it's a good city. It's a great place to raise kids and a family. And we have solid market fundamentals and demographics. I think Cincinnati has had some of the strongest rent growth over the past 6 quarters, I think, as
Yeah,
compared to the sexier Sunbelt markets that have gotten a lot of attention over
right.
the past couple of years. So
Which has gotten a little out of control.
yeah, and that's just a testament to, I guess, the conservative Midwestern values, you might say.
It's always been an area that it defies the rest of real estate from an like what generally from a macroeconomic standpoint. Do you not like they report on how the real estate market is doing in the United States, and the Midwest is like this sleeping sort of giant where it just continuously hits back, but it's not reported on. You just get coverage on Austin, you get coverage on whether you get coverage on San Fran, you get coverage on Seattle. And at the moment, there's all this talk about overbuild. Columbus, I guess you can loop into that.
Yeah.
But a lot of markets just are so consistent here in the Midwest, and they're so easy to play into and generate returns in. And that's one of the reasons why I parked my company here.
Yeah, so you and your partner Ross have started a firm called SimCap. What is your investment thesis there?
Investment thesis wise is we like being close to the assets that we manage. And we also, I'm going to dare to use the word being vertically integrated, but we like the fact that we can pull money in here and control the asset throughout its entire life, from acquisition all the way through to disposition. And that's important. I think it's a differentiator for us because we don't go third party. We don't, for the most part, we sit at the top of the decision tree, and even the smaller decisions at the moment funnel back to us. And that goes all the way down to paint color in a unit.
Yeah.
I'm not sure how that'll translate 4 or 5 years from now, but for the moment, we really enjoy the fact that we still get to be that.
Yeah, I think that's really important to equity, especially if you're attracting outside of the friends and family capital raises. They want to see that you're really
Yeah.
hands-on and know how much a cabinet box costs, for instance. I think that is a good thing for you guys. No, I think it'll do well, especially as you continue to scale and grow. And then it's about you become asset managers of your own company, and then you'll grow up and or continue to grow the firm, and you'll have people below you that are asset managers and you're making more strategic decisions. But yeah, definitely. I think always being in touch with the physical real estate and what's going on. And I think being vertically integrated is very important as well if you're raising third party equity, because then you can say, listen, it's all us, for better or for worse, I guess.
I mean, I don't understand how people, and not to just harp on about this, but we don't really understand how other syndicates, if you will, can do anything else. Because once you take invested money in, and then you just deploy it, and then it's all third party managed. Sure, you can review reports, but you have no ability to affect change, or if you do, it's delayed. I got 2 reports back and there's omissions or there's inaccurate information, so we've got to make a switch up. Like, We want to know now. We want to know day of
Right.
what's happening. And I think this was our defense against that. And it wasn't necessarily we see what other people are doing, we can do it better. It was just where Ross and I come from as people, which is we really like controlling everything about a process and
Sure.
appreciate understanding how complicated it can be.
Yeah, I think it's a big responsibility when you take on people's money to go invest it on their behalf.
Oh, for sure.
It's something that shouldn't
It
be
was
taken
way
on
more
lightly.
flippant when it was just us.
Yeah, you can afford to maybe make some of your own mistakes with your own capital, but when somebody gives you their trust to say, "Hey, take my money and go invest it for me," that's a big responsibility that I feel like with the era of syndicators maybe recently come to an end. I feel like that wasn't necessarily taken as seriously. It was just a time for folks to, oh yeah, give me your money so I can go out and get rich. And oh yeah, by the way, I'll give you some returns too.
That's what TikTok did. It exploded. It exploded that side of it. So many people view themselves as syndicators, and it's jaded the whole category to some extent. Where there's like all this stuff out there. I'm like, what's a syndicator? And lots of people that don't have accreditations or experience in real estate or really have any type of like process as to how they want to do something,
Yeah.
they go and they raise money from people and then they buy an asset. And it's like a fingers crossed. Let's hope that this kills it. What are you doing to make that happen? And a lot of the time, we just wait and real estate just appreciates on its own. And we're getting to an age where that's not the case. And you have to work really hard, especially with the increasing interest rates, that you've got to actually know how to do that. But it's a new market and it's a new environment. So it's exciting.
Yeah.
We have to be in it.
Yeah. For a while, we would get, so back in like, I don't know, 2016, maybe 2017, we used to get the same letter of intent from random people, but it was the exact same like form. And what we figured out is that they didn't know each other, but they had all taken the same weekend course on how to be a real estate expert. And then you talk to them and they're like, oh, my partners and I have 5,000 units. And it's, you don't have any. You took a course with somebody who's allowing you to call yourself a partner, but you're not really a partner yet. And it was a whole thing. You and Ross are professionals. How is your process different from the noise that we've just discussed?
Oh boy, in terms of how it's different, we start early when we're looking at buildings. We usually have an idea we always have an idea if we're looking at a particular building on how that general area has performed over the course of 10 years versus 4. And that's a critical distinction because we've had a rather unique 4 years. We have rents just like absolutely skyrocketing, and we're seeing those curb off a bit now. But history has a tendency to repeat itself, and so you have to look back a little bit further. I don't personally prescribe to the belief that going back further than 10 years produces relevant insights because everything has changed so much over that time period. But what makes us different is that I already touched on it. We we did it and we did it. We started with small buildings and we learned everything about small buildings. And we were hauling drywall in, we were taking drywall out, and we scaled as far as our wives would let us scale with our own capital, just the two of us. And that was the intent. It was like, we're going to build this and we're going to collaborate together. And Ross and I are different personality wise, but really closely knit when it comes to how one person operates, where one person has a gap, the other person fills it quite well. And so we've just clicked and it's worked very well. But then we got to the point where we've run out of money, at least from my wife's perspective. And so we moved towards syndicating and then grew that up. And now we've just launched a fund. Secret source wise, it's just being patient with the process and making sure that we understand everything about what goes into a certain stage of the growth path for most people who are professional real estate investors. We didn't get a giant sum from someone and go, hey, we're going to buy a 50 unit building at 6 million. we built to that point, and we have a track record that represents that. I feel
That's
like.
awesome. That's great. What I'm curious in looking at the data, say back 10 years, what are some of the insights that you found on deals that you've decided to go forward on versus maybe the deals that you've decided to pass on?
What did you say? What, 10 years ago?
Because you're saying you like to look more at data instead of just the past 4 years, you think looking back over 10 years is important. So I'm curious,
Yes,
what are some of those things that you found? Because I too am a big believer in data and analytics. And so I'm curious
sure.
what you're seeing.
So we found that some of the most stable assets in terms of vacancy rates, stickiness of tenants, and the potential of the owners to be more likely, the buildings are less likely to be owned by larger asset managers, which might have their own operating methodology, and it's very scripted, and you can look at one building versus the other and see the comparison. We found that buildings that are about 50 miles, if you look at 50 miles from the center of a metropolis like Cincinnati or Indianapolis or Columbus, those areas have the most interesting real estate because they oftentimes are larger assets and they're not being focused on as halo buildings that a lot of developers, or not a lot of other asset managers buy, knowing that the cash flow is not going to be there and it might not be there for 5 years. We find that those areas are the most lucrative to look at and examine because they have really strong working bases. They're usually within a 30-minute drive of the city center, but they're not just prioritizing the location based on the fact they can walk 15 minutes to the bar that has the brand equity of a bar downtown here in Cincinnati. They have different spots that are further out. They also have a lot of chain restaurants, which is a shame. But
Yeah.
there's more. There are more like some of the iconic restaurants that are located inside of major metropolises moving outwards as well. They're opening second and third locations there, which is really cool to see. But you're betting on the fact that continues to happen, and that's where we find the majority of our deals, and we really like those areas.
So it sounds like
I'm not sure that answers your question.
yeah, no, it sounds like your thesis is around looking in the areas that others are overlooking because it's not the sexy, cool neighborhood, as a for instance.
Yeah, it's a good way of articulating it, actually.
Yeah.
What's your perspective on that?
I think that there's a lot of people that have made a lot of money on that strategy and doing things like that. Yeah, especially as the city, we're out of land here downtown, right? And you can go vertical, but that's super expensive. So that just means that as the population continues to grow and expand, you're going to see people growing out into the areas that you're focusing on. Think about like
Right.
Lebanon, for instance, which is north of, it's like halfway between Cincinnati and Dayton. As these two metros kind of converge, that market is filling out and you're seeing new construction projects up there. We've got development sites up there. We put a senior housing site under contract up there. So that's just, it speaks to that thesis that you're talking about. I've also seen it in Richmond, Indiana. You've got seeking yield, you find opportunities there. It's a sleepier market, but it's within driving distance of jobs, and there's some employers there. Fort Wayne, you don't think of Fort Wayne as like a thriving metropolis, but it's a really strong market.
And you
Yeah,
have internet service providers that are deliberately connecting places like that because as jobs continuously are able to be done remotely, that's important. And people are more comfortable living. They can live for less, but do their job as effectively as they would be able to do it if they were living 5 minutes from downtown of any one of the cities that we're talking about here. But they are increasingly choosing to move a little bit further away, still very much drive, still able to get an Uber to it, but they have much better living standards. They have, whether that is more money in the bank each month or whether it's a larger apartment, which is good, in my opinion. I don't understand how people live in shoeboxes. It drives me crazy. When we were just in New York, like I said, and the majority of New York apartments are like less than 400 square feet. That would drive me crazy as a 32-year-old.
Yeah, they're
That would
they're
just go
cozy.
insane.
Yeah.
They're super cozy.
Yeah. What do you think about we're in an interesting time right now in the market as far as we've come out of COVID and then we have these, you could say record high interest rates, but really just returned back to normal interest rates. Where do you think we are now and where do you foresee the market going, say, end of the year or into the future?
I think there's some pretty powerful people that are indicating that 2024 will be another rough year for rent growth in general. But a lot of the Midwestern cities, I mean, similar to my previous point, they they buck the trend as it relates to that general sentiment. And despite the fact that rent may be decreasing, the average purchase price for multifamily apartment buildings is continuing to stay level. And that's a positive macroeconomic indicator, is that there's room to grow. You don't have, there's no panic selling of assets. And that's a really positive indicator for us when
Yeah.
we look at it. So we try not to speculate on things like rates. Everyone, it's the first question. I've asked you the same question. So I know it's a popular one to ask, but I don't know. There's not a good result for me to answer the question. I don't know. I hope they improve. But at the same time, I don't know.
Yeah. Rates are everybody's favorite topic to talk about, but nobody has any idea what's going to happen or where they're going to go.
No, not at all. And I'm a big fan of agency. I'm a big fan of controlling something. That's one of the reasons I transitioned from banking to real estate, is that you can control as much of real estate as is possible for an investment. I cannot control how Procter and Gamble reports. I don't know what they did. I don't know how their brands are doing individually. And it's, oh, earnings season came up and they didn't hit what was estimated. And so the stock goes down. I had no influence, but I love real estate because you do have influence and it's all out in the open, literally.
Yeah. It's pretty simple unless you get over your skis. And there's a couple of ways to do that. Like you buy a deal with unrealistic rent growth projections. That's a good way to do it. So you
Yeah.
basically overpay for it. Maybe you buy a deal with floating rate debt and the interest rate resets on you and you're like, oh, what have I gotten myself into? Because now your payment is greater than or equal to whatever your net is after all expenses. And that leads to deterioration of the asset if you're going to try and keep it up, or you just end up giving the keys back and all of your equity evaporates and nobody wants that. But yeah, real estate is just even keel. Keep it pretty even and you'll be all right.
What happens? Obviously, you run the Capstone Group here. So, like, what happens when someone who's a client of yours underwrites a deal and they're making assumptions like that? They're like, or not assumptions. That's how they're underwriting it. But do you guide them, or do you say, "Hey, that's a really dangerous assumption to be making"? That I'm
Um,
genuinely curious.
yeah, that's a fair question. So I believe what you're asking me is what do you do as a broker when you have a prospect looking at buying a property and maybe they're overshooting some of their
Yeah,
assumptions?
yeah,
So if it's a listing, my duty is first to the seller. However, to be a practical person, we're doing both sides of the deal the majority of the time. And so the hope is that, okay, if I sell this person a deal, I want to see them be successful with it because once they have run their business plan, they will come back to us and sell it out through us. That's the game
okay.
in brokerage. Sometimes, especially in like a competitive bidding process, we'll ask to see somebody's underwriting. Help me understand how you're looking at this. And like a big bogey oftentimes are groups in Ohio not accounting for a reassessment in real estate taxes. That is, we'll see taxes sometimes quadruple on a sale. And it's silly, but that's the way it is. We want to make sure because, all right, so here's the risk. If we don't say anything and we let them make dumb assumptions, like not reassessing for taxes, then they get into the deal, they get under contract, they're at an above market contract price, you might say. So they're the
Yeah.
highest bidder, for instance. And so at that point, it's our job to talk with the seller and say, okay, this group is the highest bidder, but they haven't accounted for a reassessment in property taxes. So it's likely that if they buy the deal and they figure out the taxes are going to reassess, we're going to have a retrade or it's going to fall out. Do you want to take that path? But so that's the message to the seller. But also, before we even get to that, asking to see the underwriting, let me understand your assumptions. And more so, it's because they're not high enough on price, so we have to push them up. But in our buyer questionnaire, it's specifically to address how are you underwriting property taxes? Because we want to avoid that bogey as much as we can. Or the abatement. Are you valuing the abatement properly? Because sometimes they're not. Sometimes they don't understand how, new construction or newer construction have property tax abatements where your taxes are a set amount for 15 to 30 years. And so it's okay. How we almost have to coach prospects in that instance of how they should be looking at how to underwrite the property taxes. To answer your
Yeah.
question, I'm not going to lead a lamb to slaughter. I want to make sure that people are making wise decisions. But if we've gone through it and they want to stick to it, okay, you're your own person. Like it's
Yeah.
it's your world. I'm just living in it. But there's also some checks and balances in there. Like the lender is going to be like, are you accounting for property taxes? They've done this enough. They've done it thousands of times. So they're going to make sure that any prospect is accounting for, again, a reassess in property tax, or like it used to be that insurance was 50 a unit. Like that was almost gospel. And now we're at like 550 to 600 a unit. So it's okay. My mantra I'm doing this small redevelopment deal and it's my first like real heavy, it's a shell building that we're framing out and insulating and all this. And I think what I've learned or picked up from my prospects and clients is surround yourself with good people. And I feel like the rest will take care of itself. So
Sure.
a
Good
long
people
way
can
of,
also be wrong, though.
sure. But that's why I don't know, you're almost crowdsourcing from a number of different folks. Give me 3 different insurance quotes. Give me 3 different bids for electric. Give me 3 different bids for plumbing. And then it's not always best to choose the lowest bidder. You want to make sure that you're having a conversation and make sure that this person is competent and capable of delivering on the bid that they've issued you. So I have a great HVAC guy and he was significantly lower than the competitors. And I was like, help me understand how you're going to be able to do this. And we talked it through and it's okay. I feel confident he's going to be able to get through the deal and deliver on the bid that he's issued. So we'll see, but I have confidence.
I have confidence in.
Yeah.
There's the whole difference between value creation and value extraction. Like value extraction is what I would argue has happened over the past 2 years, which is find the cheapest person that you can, and the quality of work is secondary to the the longevity of the property. It's like just get it done because we're going to paint this after you're finished, and then we're going to put it on market and we're going to shift this puppy. And I
Yeah.
hate that. I really hate that. And we've bought a number of buildings, no one that I will name, but from groups that I'm like, wow, there's no way that someone that's at a higher level didn't understand that this was happening. There was a decision made around what to do and was it the correct thing. And I'm a bit surprised by that. I also understand and appreciative of the fact that people have investors and need to deliver returns for them. But let's continue to create value in the buildings that we buy, and you'll still find the opportunity to resell those and make a good amount of money, make your returns for investors. Maybe they're slightly curbed, but as long as you have some type of accrued preferential payment, they'll recapture it at sale. But I don't know, Ross and I share the sentiment that but just doing things in a sloppy manner just to get them done at the cheapest rate is a poor reflection of you as an operator. And there are some excellent groups here in Cincinnati that do it really well. And then there are some groups that surprised us.
That's called putting lipstick on a pig.
Yes, that's the expression.
And yeah, I guess it depends on who you're buying it from and what their strategy has been. If they just want to churn in and out of buildings, that's probably what's going to happen. So it's one of the hazards. As long as you go in with the appropriate capital budget, you'll come out right on the other side.
Yeah. If you're doing it long term, it doesn't necessarily matter, right?
Yeah.
You're leaving a legacy behind, and that building will retrade and it won't fall apart, and they'll recognize that it was purchased from X group and it did a really good job of staying together.
Yeah.
This is falling apart.
You mentioned you're raising a fund. Is this going to be an evergreen fund? What's going to be the hold period? I'm curious, like, why did you decide to go after a fund model, which to me seems a little bit more complicated, as opposed to doing it deal by deal?
Let me tell you that it was more complicated from a setup standpoint, because we've done a number of syndications, and the legal work involved in setting up a syndication versus setting up a fund, very different. The main reason we moved towards a fund is because when you do individual syndications, it places a lot of stress on the operators, which is Ross and I, and we actually just had an asset director start with us last Monday.
Nice.
And he's great. So we do have a team of three on the capital side of the business now. But we moved towards it because when you do individual syndications, you spend most of the time during the due diligence period raising money. And really, during that period, you should be making sure and confirming and reaffirming that all your assumptions about the building are correct. And that doesn't just stop with the inspection timeline. That usually people inspect it and they're like, okay, it looks good. Now I'm going to financing. It should be like an arduous process of researching and confirming what other rents are in the area, making sure that the economic growth is there, trying to uncover through relationships in the area what's coming up that might not be public knowledge at the moment, making sure that you are really making a good buy, especially if you have other investors involved. And when you syndicate individually, you're locked out from that because buildings trade quickly. You guys have listed buildings before that we were too slow to act on because we had to dedicate time towards raising money from individuals. And it just, it's always a bit of a gamble. And you have to make sure if you have to come up with $2 million, oftentimes you have 40 days to do that. And you're making calls for relationships that you've established in the past. But you really should be focused on verifying that this asset is what you think it is, and it will perform the way that you think it will perform, and your pro forma is accurate, and you can possibly beat it. That's the main reason to do it. But I'll preface that by saying you do have to have done it several times before you move towards a fund, because the people are looking at you. Okay, well, what has this person done in the past? Are they able to recreate it? Is there a team behind them that's intelligent? But that's the major reason that we did it, is to enable us to focus more on what we're really good at, which is valuing buildings and sourcing them and then getting people excited about them. Now, I'll tell you the major challenge is that you don't have a product. You don't have a building to walk them through.
Right.
And so we're trying out some new marketing things with how to bridge that, because I think people want to hear what buildings we're turning down, what buildings we are considering, because we're constantly going through that process of evaluating what's happening. And okay, this deal came in, let's get it underwritten. Is there something missing? Can we make this work? Yes or no? So we're trying to get better at making sure that investors are aware that we know that, or sorry, that they know that we're constantly looking. And we're looking to, we'll wait until we're about 25% of the way funded, at least in terms of our cap, which is 20 million. before we make our first acquisition, and we'd like it to be a really good one.
Nice. How has the receptivity in the market been to raising a fund? I know you just talked on the fact that you don't have an actual product, but has it been well received?
It has been a bit humbling. And we haven't fundraising is the thing that most people hate to do the most. I think if you rewind 12 months, I really did hate it. But now it's morphed into kind of a passion of mine where it is, as long as your perspective is don't worry about the no's, because it's not a no to you. It's a
Right.
no based on that person's individual circumstances. And then those change. And we've had people that have said no to us on one deal come back 6 months later, we bring a new one to them and say yes. And in our opinion, the deals are no different, but it just doesn't matter. Does it happen? Does it work for them at that point in time?
Yeah.
And we've been happy with the receptivity. We're still working on it, and we'll get there. We have no doubt. Although we've explored other options as well as all sorts of creative, like pref equity plays that are now starting to dominate the market. But that kind of goes back to my value extraction versus value creation issue that I think much of Western America, and I'll include Britain in it, as capital groups that are focused on let's just grab this guy's coattails, bring a big check to the table, and then control everything about what he does because we brought the money. And it stops the people that are really passionate and spend all their time studying real estate from being able to do what they do properly, because you've got a capital group attached to you that has their own mandate, that is only interested in the profit generated. They have no interest in the manner of improvement for the lives of the individuals that live there. They have no interest in what it's done for the city in general. It's just a play on how much money can we pull out of this particular deal before we reposition it to another one. And there's nothing necessarily wrong with that. It's just, I hate how much it's bled into real estate, because it used to be something that it just used to be locked up in categories that didn't really focus on real estate. I hate the idea that major hedge funds own tens of thousands of single family houses. I think that's
Yeah.
bad, personally.
Yeah, I'm of a similar opinion. I was talking about this morning actually with somebody with a public entity, and we were talking about the mass ownership of single family homes. And he had the exact same point of you have these large companies that just come in, maybe buy a house for 60 grand, milk it, 3 bedroom, 1 bath house, which is essentially functionally obsolete. They don't put new roof on it. They don't put new windows. And then maybe they sell it for break even. Maybe they sell it for a little bit less, but during that 10-year of ownership, they've just taken everything out of it. And it's not adding back to the community. And I don't know, real residential real estate from the perspective of the investment standpoint is a tough game to navigate, to balance, because on the one hand, you have these are where people are living, but on the other hand, it's okay, capital does demand a return. How do you effectively balance that? And I think finding a way to be able to do that is a key to success in real estate.
Yeah, absolutely. And finding people that support you and buy into your vision is, it's Ross and I had a conversation at the end of last week when we had a number of meetings, and I'm not knocking the partners or the people that we met with, but we were just like, let's just raise the money. Let's not take these shortcut routes where we'll get bled by their terms. And a lot of the time they want to set everything about how the deal works. They want to say, okay, we get to determine when you sell, and we get to determine if you're allowed to refinance. And we get to what on earth are we doing then? That's what our skill set is based around. We can see what's happening, and we know that there's this new development that's taking place around the corner, and they've unfortunately run into a delay because the property manager or the developer was fired, and they're finding a new one, but it is still going forward. It has government support. it's going to materialize and then it will absolutely help this building. But they're not interested in that. It's they have the return objective, and it's no, I don't care. We're gonna sell now. That's it. That can be challenging for people
Mhm.
in positions like Ross and I. But again, I'm not trying to just shit on them. Sorry, I should check if I could swear. Crap on them. You can cut it out. Um, I'm not trying to do that. I'm trying to just. It's a changing landscape at the end of the day, and
Yeah.
you have to respond to it and understand where you can generate value and how you do that.
Yeah, um I think the way that you find that appropriate balance, and I don't know how you control equity necessarily. And I do want to ask you, what are some of the things that you found to be effective in raising capital? But I'll finish my thought first. We've got some clients who, so early in my brokerage career, I was touring this deal and it was 275 units plus or minus. And it was in rough shape, right? It was like when a lot of deals were in receivership or they're owned by lenders and things like that. And I was like, Bill, how are you going to turn this thing around? It's easy. You give people a clean, safe place to live and you respond to maintenance requests. You'll always have tenants. And I was like, oh, that's really good. And then that's always been stirring in my mind, especially as I've taken on some of my own projects. And then we have another set of clients that take that same mantra. It's pretty simple, but then they take it a step further and they offer the nicest units in the market. And what we see from them is that they become their own comp set. Like we'll be looking
Yeah.
in the market and we're comping against other deals that they own because those are the only properties achieving those same rental rates, but they're also the only properties that have the same, level of finish. And if you don't, I think it's a borderline or it's a fine line to walk of improving it and then potentially over improving it.
Yeah.
Because I asked a developer one time, I was like, why don't we just build more Class B housing? If you think about it, the hard costs are about the same, whether you're building a Class A luxury. Because I was like, I don't understand why all luxury apartments are being built predominantly. Anything built without
Mm-hmm.
a subsidy or a tax credit is luxury. Framing costs the same, drywall costs the same, paint, flooring. It's only the finishes that really change the level and the amenities that change the level of rent that you can actually charge. And that's a small percentage of the overall deal. I was like, oh, okay, that makes sense. Does that make sense?
Yeah.
Yeah.
Oh,
Uh,
totally.
yeah.
And I know the group that you're referencing, and I think they do an awesome job of it. And it's one of the things that we're looking at the moment. And our asset directors is working on like a fit out list that will enable us to get that kind of look. But you can do it now so cheap compared to where you had to,
Yeah.
the way that you could do it, you had to do it before. Like a little bit of under counter lighting goes a long way. It really makes a unit pop.
Yeah.
And you
And they're
can buy
just
those
basic
strips on
LEDs.
Amazon.
Yeah.
They're like $15 and they plug in. And that's awesome.
Yeah.
We have you can get sconces now that are beautiful that are mount to the wall and their batteries, they'll last for 2 months. It's okay. Once every 2 months, the tenant has to change it out. So you can buy the sconce and install it from sconces inside the bed, whatever, for $140 for two of them. Or we can spend the better part of $850 wiring everything so that you have a light switch. The sconces work, clap off.
The
They're
clapper.
arguably they're arguably more they arguably resonate with tenants more. Like it's modern. So and I don't consider that to be a shortcut. I just consider it to be a better way of delivering high quality units to tenants at a cost that it doesn't become prohibitive to them.
Yeah.
We're
Working
really
smarter, not
interested.
harder.
Yeah, working smarter, not harder. Exactly. Plus, here's the added advantage: is that if you have to replace the batteries every 2 months, it's a good reason to go into that unit because we'll replace the batteries for you, and we get to make sure that you are living the way that makes sense to live.
Right.
Not that we're going to make judgments. We're just going to make full. We're going to review it in our weekly meetings and say, hey, this person's unit has got clear marks of a fire on the wall or something like that, which we always hate to find out. I hate finding that out at the end of the tenancy when they've allowed that fire burn to grow and grow because
Geez,
no
have
one
you
bothered to.
found that? Have you seen that?
Oh yeah, we've seen that.
Oh,
Some with
wow.
an some with an oven that maybe the thing, but the what's it called, the heat guard behind the oven is dropped behind it, and rather than call us to replace it, it's like, oh, it'll be all right, and then just scorch marks appear further and further up. It's like you could have done something bad there.
Yeah. Help me help you, please.
Yeah, help
It's
me help you.
literally my
I
job.
want to I want a reward system for our tenants whereby if you report an issue to us in a timely manner and it's one that would have turned into a more significant one, there should be some type of bonus that's offered. Because the number of times that we find out that a tenant there's been a leak under the sink, and then when they move it, they're like, oh, it's been there that the whole time. Why didn't you tell us? Now we have to replace the whole cabinet and it's leaked down through it into the floor below. Just tell us and we'll fix it. So we're working on some type of reward system for that because we really appreciate tenants that do that.
Yeah, I guess you could offer like a Kroger gift card or something like that, or Amazon something. But then, and I'm not speaking ill of anyone, you just don't want people to game it either.
It's right. They're deliberately unskewing the nuts.
It's
And they're
so
just letting
weird.
water drip out.
You fixed it last week, but it came back. I don't know what happened.
Damn it. Found the problem.
Yeah. Oh, that's good. So I do want to ask you, what are some of the successful things or techniques or tricks, or I don't know, in your capital raising? What are some, because I'm thinking about it selfishly from my perspective in we're doing our friends and family capital raise. How has that gone? What advice do you have for folks?
Okay. Start with your own money. And that means if it means going smaller, it means going smaller. But start with your own money because it's the least stressful to a certain extent, because it's just yours. I'm a people pleaser, so I hate the idea of anything going wrong for someone else. I'd rather it be me that owns it. Start with just something that you can afford to buy, then circle your friends and family network. And after assuming you've been successful and want to continue to do it, and you'll find that people will come forward because they love you or support you, they understand you, and also the fact that you're going to bump into them. If you're not doing that, you're going to hear about it at the barbecue. But then once you've done that, maybe once or twice, then you start going the route of, okay, we now have to start pushing a bit to networks outside of this. And our greatest successes there have been speaking to people that are 1 degree removed from our close friends and family, not necessarily going after them for capital, but asking them if they know people that have capital, because then they feel like they've been recognized as someone that is worthwhile to make introductions to. So there's a certain amount of pride that comes with that, and they're infinitely more likely to make the introduction. I'm stealing this idea, by the way, from a book. I think it's called Givers and Takers, and it's a more effective way of fundraising to leverage the pride that comes with an ask from someone that's not close network. If you ask your closest friends and family to make introductions on your behalf, first of all, they probably know the same people you do, and secondly, there's just more tolerance for not doing it because they can just tell you straight up, I got busy. I'm like, sorry. But like when you get 1 degree off that, or one LinkedIn connection away, and make a specific ask, you reference the fact that they have been identified as someone that is well connected, still in a sense of pride, and then they are more likely to connect you to someone that is in a position to potentially extend to you a line of credits or a direct investment for equity, whatever it looks like. The tips can continue to build from there because we've learned a lot in terms of capital raising over the past couple of years. But in terms of getting started, those are the top ones that I would articulate.
I've found that myself. Like I tend to, I give away a lot of referrals to other people because I want to, it's that same phenomenon that you're talking about. I want to just help this person, assuming I like them.
It's
Myself
key.
giving away a lot of referrals. Oh yeah, you should go talk to this person. Here, let me connect you. And all in the hopes that it makes, dare I say, it makes me look better, I
It
guess.
absolutely does. Yeah, no, we're hugely impressed with you guys. You've connected us to a number of people, and not even we know the undertone is it will come back full circle, but it's not like that's a part of the introduction. It's generous, and it's yeah, meet this person. I think that they're going to help you. And it doesn't you never attach asks to it or anything like that. So we really appreciate you guys for that.
Yeah,
Seriously,
absolutely.
that's been helpful.
Awesome. Let's wrap it up here. Josh, what is the best way for people to get in touch with you if they are interested in hearing what you guys are doing, maybe talking about investment, things like that?
So our website is simcapholdings.com, and simcap is simple capital pushed together. So you can get a good overview of the portfolio as it exists today. If you're an accredited investor, and I do need to make sure that's
Hmm.
clear, you can fill out a form and get access to the offering memorandum and the other legal documents associated with our current fund and what its purpose is going to be. And then you can go to us directly. And the best way to do that is inquiries at simcapholdings.com, and we'll circle back with you. But we're happy to talk to you, whether you are a potential investor or whether you're someone that's looking to get started. Because if there's a mistake that's to be made, we've made it and we're still standing. And
Yeah.
that mistake should be looked at as something that is a positive, because the earlier and faster you make them when there's less capital on the line, the better you are dealing with them further down the line, and the more confident you are about dealing with them.
Yeah. I think this generation of real estate professionals, and not to say that all of the previous generation is like this, but guys like yourself and other good clients of ours, they're ready, willing, and able to help and extend a hand. And I think that's awesome. So thank you.
Absolutely. Yeah. Thanks for the time.
Yeah.
Um,
Cool.
cool.
Josh, I appreciate you joining us and I hope you have a wonderful day.
Wait, can I give you one more? It's
Yeah.
not you asked me to do this, but what is needle, by the way? I didn't get a
Oh,
chance to ask that at the beginning of the
let's
podcast. I
go.
swear this isn't set up. What
Um,
is it? I have no idea what that is.
yeah, Needle is a predictive analytics platform for commercial real estate. And as it came initially as an idea that I had where what I found in my brokerage practice, Josh, you've got 20 assets in your portfolio. Are you interested in selling any of them? No, is your knee jerk reaction. Okay, great. Thanks. I'll talk to you next month. And that's assuming you have a terrible lead in. But then what I found is okay, so you can't call and ask somebody about every single asset in their portfolio. That's annoying. But what I found is that if you call and say, hey, Josh, I want to talk to you about this specific property, you're much more inclined to be like, we actually were just underwriting that the other day and evaluating it as potential sale opportunity. Or not that one, we're not quite ready, but what about this one over here? It has a lot of the same characteristics. So I was like, okay, how can we figure out which deal they might consider selling without going through the whole portfolio? And that was like ruminating in my head for a while. And
Okay.
we have data platforms out there that function more like encyclopedias. They have all the information, but they're not doing anything to look forward. They're just looking backwards. My thought was, what if you could use all that data that's out there, apply some analytics to try and predict which transactions might occur and then go get in front of it? I had spec some cash on some of that. UC was doing a learn to code in Python class. And I was like, I don't have the time bandwidth. I'm a little dyslexic. I definitely have ADD. I'm not the guy to go and take this class, but I got in touch with the guy who's teaching it and I paid him to do some analysis for me. He's like, yeah, I think you have something here. But that was the end of the assignment. So I was like, all right. And then I had a friend come to me who I've known. I met him through my wife. They used to work together. And he's, hey, Stash, I have this great idea. He had this great pitch deck. I have this great idea. My partners and I have a background in software, and we want to buy value add real estate. And I was like, that's a great idea. But you and everybody else And if you guys have a background in software, what about this? And so I pitched him, what if you could use data and analytics to predict real estate transactions? And he's like, all right, let me go think about it. And he went and talked to who's now my other partner. We had lunch like the following week, I think. And they're like, yeah, we think this thing has legs. Let's go test it out. So what we did, I'm telling you the long story of it, but what we
That's
did
fine.
is, so I have a team of data scientists and engineers, mostly overseas, and I taught them how the commercial real estate world works generally. And one of the things that I've learned as a broker is that a property will tell you, if you can see, if you have insight into the data, into the operations, the workings of the asset, the property will tell you when it's getting ready to be sold. So I talk to my team, hear the things that we see when somebody comes to us for evaluation. You'll see a trend upwards in the T12, 6, and 3. You'll see maybe a tightening of expenses. You'll see an increase on rental rates, tightening of occupancy. Maybe a loan maturity is a dead giveaway. But so we took all these factors and they applied some models to it and started sending me, myself and some other people here at Capstone, Excel spreadsheets. And it was awesome because I would get like 20 leads on an Excel sheet and 8 of them would be in play. And I was like, oh, like we would have it
Wow.
listed, a competitor would have it listed, it was under contract, like we were valuing it, something was up. So like without any input from what we were actually doing, it was just like, here's a lead list, go call on it. And some of them were, no, we're not doing anything. Okay, that's fine. So then we went and we proved the hypothesis that we can get insight into which deals are likely to trade. And so we went and built a platform. So we've got, what we've built it around is every multifamily property in the US above a certain unit count. And we've ranked them hot, warm, and cold, or no ranking. And we have a map in there. We have the ownership information, the loan details, any notes that you may have associated with it in calling. And then for brokers, we have a match buyers function. So that looks at, okay, who are owners of properties similar to this, both in this market, the submarket, and similar submarkets. And here's a hot list for you. So if you get a hit on a deal, call these people first because they own deals similar to this. Chances are they might be interested in your deal. So that's what it is. And we're in our beta testing phase. And we're just working to get our data set fully ironed out so that we can start to monetize it and take it to market. So
Sounds
that's what it
awesome.
is. Yeah.
Very cool.
Yeah.
How big is your beta test?
We have about 100 users in the platform across maybe 15 different groups. We've got some lenders, owners, and different brokerage shops in there.
That's awesome. Yeah,
Yeah.
I had no idea.
Yeah.
I like how tech forward you guys are in terms of real estate and looking forward.
Yeah. We're trying. Definitely trying. It's got me working. Legit am working like 12 to 14-hour days. So it's fun. That's why I do this though,
Well,
because this is fun to me.
thanks for carving it out.
Yeah,
Teach me about it. When the product comes out, or if we can help in any way with the beta, let us know.
for sure. I definitely will. All right. On that note, have a wonderful day, Josh.
Thanks, man.
All right.
Okay.